finance, these sort of questions emerge. Two great pieces of news. First, talking about entrepreneurial finance is actually super easy, and I can do the dialogue really, really fast. That's great news, and it's all on the board. I'm just going to walk you through it really quickly. The second is it a 5-week course or a 10-week course?
It's at least 10.
So there's a 10-week, the best part about the university is that we have an entrepreneurial finance, not a venture capital course, but an entrepreneurial finance for entrepreneurs class that starts, it happens every year, and it's 10 weeks long. And the course is not about how to be a venture capitalist, nor is it about how to do comprehensives in companies. It's the process through which individual entrepreneurs gut out the painful, alienating, difficult, fun, weird, crazy world of entrepreneurial finance, and we have great venture guys who come in that give honest feedback.
Now, we teach it under the guise of how to be a venture capitalist.
Yeah.
But inevitably, when you're done, nobody wants to be a venture capitalist,
yeah.
Which I treat as a success.
Yeah.
When is it? Is that?
Not because we don't want the competition, but because we try and tell you how it actually works.
Is that this summer or fall?
Yes, it's summer.
Bio. I hope. Oh, that's a small. Oh, no, it's a good bio. There you go. So I know I'll put 10 up there too. It's working. Okay, so the question in entrepreneurial finance is this, and given this question and a few criteria, you'll be able to have a rich conversation with these two guys who are professional VCs. And most of what you need to understand about entrepreneurial finance you'll be able to infer using your inner economist. The question is the following. Why can't banks handle all financing? Did we cover this in my, you weren't in my entrepreneurial finance. So you were, weren't you? Right, so you're not allowed to talk because you already know the answer to this question. Right? So the important question in entrepreneurial finance, the question for what, it's said another way, right? This is the other side of the coin is, why do venture capital firms exist? Right? Why can't banks handle all financing for everything, everywhere, all the time? Parenthetically, once you answer that question, you then have, a case could be made for what a venture capital firm is and why they have a right to exist. So, first, in order to see how fast to move through this conversation, how many of you are aware, how many of you have taken a class where you talked about the structure and composition of venture capital firms and know what they do, like formally?
How many?
Yeah, total. Just I need a hand raising for these guys. So half. Okay, so half of these guys have a sense of what venture is and half don't. So that should help you. So why can't banks handle all financing options?
Glass-Steagall.
Glass-Steagall. So what does that mean?
Well, there was a law that was passed that said investment banks and banks cannot hold stock in a company. So because of that law, you had to have a separation of investment banks and commercial banks.
Okay.
Which eventually was reversed in '99.
And that's actually quite helpful. So said another way, so one potential answer to this question is called Glass-Steagall, right? That's actually the first person to advocate for it, right? There potentially one explanation is a structural explanation. So I'm going to build on this. So first explanation for why banks can't handle all financing for entrepreneurs is a structural one. They can't because they can't, because there's a law in place that says that that financing entities, banks, cannot take equity positions inside companies. That's reasonable. However, you were going to say something.
But I think the law was based on the risk analysis of new businesses versus traditional, or where you have equity in real estate as opposed to your IP as the people. This is high risk still for.
So there's some. I'm going to have you hold on to the risk piece because you're actually probing at the other side of that equation. You're coming into the back door. So we're going to go in the front door for you. So great. you've just explained to me why banks can't hold equity positions. I'm going to grant for a moment that banks can't hold equity positions of entrepreneurial firms. And it's absolutely true that most entrepreneurial firms would prefer to trade their equity for cash, right, because they're resource efficient. But you have not answered the question about why venture capital firms exist, because I can imagine a world in which banks didn't need to take equity positions inside companies. They just did traditional loans and debt financing. So you're absolutely right. It explains some aspect of the venture financing ecosystem, but it does not yet explain why we simply can't, for a barbershop, an iPhone application, an enterprise software company, work out some loan agreement with a loan officer. Yes.
I mean, I don't know if this is right, but I work for a bank. It's hard.
I'm sure it's wrong. Whatever you're about to say, since you have experience, I'm sure that it's wrong. No,
But I mean, we work in risk at the bank, and a lot of times with the types of things we're talking about, that is more principal uncertainty risk. It's very hard for us to measure and calculate uncertainty. Whereas if you are an expert in whatever that person is, or you have a pool of talent that understands the business, they can measure uncertainty better.
Okay, interesting. So you're suggesting that for some types of new businesses, right? They have some set of characteristics. You're using uncertainty risk. We'll just cool it for a minute. We'll just assume for a moment there's a class of businesses that have a certain set of characteristics that you as a banker are going to find unattractive. And as a result, you're going to reject, when I come to you with my cool new enterprise software application, you're not going to be all that keen about it.
Me, the banker, might be.
Yeah.
Me, the personal entrepreneur, might
Yeah.
not.
Okay, so other thoughts? I'm going to probe in on this, but yes.
A lot of loans require some sort of collateral that a new firm may or may not have, especially in the service industry. If they flop, there's nothing the bank can come in and collect on.
Interesting.
To cover their loan.
That's right. Go ahead.
Besides just collateral, you know, and I used to underwrite commercial loans, and they needed it all went on cash flow, and if the business itself can support it, and a new venture where they need the money to scale and to get bigger, they won't be able to support that. Maybe they're at break even or still losing money, but the market is proven at this point.
There is no cash flow.
Well, that's exactly it. So it's there's no cash flow or negative cash flow, or yeah, maybe they're free anything.
So there's some sense in which you said something interesting. I'm going to trust you since you're my banker guy. Now, just like I'm going to infer you're going to help me with all this stuff because like I'm just talking head, actually don't know anything. I'm just reading about shit on the internet and talking to you guys. So a challenge that you would face in financing a business is if it is the case that that debt investment requires that you're somehow able to estimate a residual payment, right? You're basically estimating a residual, both numerically calculating a residual, $200 a month, right? An interest rate related to the risk. So if you had told me, by the way, just as a joke, if he had said, well, firms that are risky, maybe a bank doesn't want them. I would say to him, well, that's not true. We could simply price the risk into the loan, could we not? Right? So continuing on the chain of reasoning, right? So one of these characteristics about a class of firms, where you guys are at right now is, okay, clearly there's a class of firms in the world that are unattractive to banks because banks are not investing in them. I would argue that one of those characteristics is not that the firm is risky, particularly risky. Or at least if that's a problem, it's not the most crucial problem. Because we could simply choose, if we wanted, to have a very large, you would say, Rob, I'm happy to give you a loan for your enterprise software application. It will be a delight, we'd be delighted to have your business. And it will cost you 25% interest rates. That's what your credit card does, by the way. Right? They're capable. An important feature of this conversation is that every piece of the entrepreneurial finance life cycle can be explained through the underlying parabola that I'm giving you. One of which is like, if it's not about risk, because if it were about risk, we could price that risk out just like a credit card does. What you said is something else, which is both curious and noble, which is there are some businesses that where it's difficult to price the residual. You can't get at the monthly payment, and the business doesn't have any cash flows to pay. So that's an unattractive business, right?
From a risk standpoint.
From a risk standpoint.
Correct.
Right? Just simply, they're, as you would say, but you were making a case that's a pre-revenue business. Okay, so there's a certain kind of pre-revenue business that I might be unwilling to take a risk on, right? One that has a very long, uncertain time horizon. So in which revenues are both uncertain, their arrival is uncertain. So a bakery, for example, is not an uncertain arrival, right? You simply start baking cakes, and 6 months in, your loan for your cake bakery, is that right? Well, eventually, if you saw the cash flow, it's like, look, I'm not going to make money now, but I'm pretty sure that if I have a volume of 60 cakes a day, I will be able to quickly reach a point where I can pay you back, right? So I will get known cash flows in the future. I have enough now to pay for my loan installment until the date that I'm cash flow positive, and I can make a compelling case for you to do that. There are some businesses in the world, unfortunately, that are not like cake shops, that it's difficult to both estimate when those revenues will arrive, right? It's difficult to calculate that frontier, so he's unable to create that payment, right? And the size of those revenues, like the market may actually be unknown, right? Now the bakery is an interesting example because what happens if my bakery goes south? Let's say that 6 months later, as it turns out, my estimates were wrong. I did not, in fact, sell 60 cakes. I only could sell 30. You're able to know that as my loan officer. I'm able to know that as the entrepreneur. And it's pretty clear that if I'm doing 30 to 60, it's either going to take me a lot longer to get to break even, and you may not like that, right? Or I may never get to break even at all, so I'm going to hand the keys over to my bake shop and default on my loan. And what do you now have?
Assets.
And what do you do with them?
We keep our losses.
You put them on eBay, metaphorically speaking. So the first key component to the characteristics of businesses that loan officers do not like are businesses with high, the fancy pants word is asset specificity. You remember this? So high asset specificity is that the assets of the business are deeply, deeply entangled with the business itself, with the idea. So the highest asset-specific business would be a software business in which most of the algorithms, most of the intellectual property are tied up in the heads of the coders that are doing the work. That is highly asset-specific. Unfortunately, we have changed the laws in the United States such that you, Mr. Banker Guy, are not able to recoup me, the software engineer, and sell me on eBay, metaphorically speaking. Slavery, unfortunately, is illegal in the United States. Right? If it were, it is possible to imagine that crafty banker man could say, I am happy, and as a matter of fact, we did do that back in the day. It was called debtor's prison, did we not? Right? So we would recoup our losses by sticking you in jail and punishing you and sticking you with sharp sticks until you cried or until your friends and family gave you enough money to pay you out. So asset specificity is super important. As it turns out, in the entrepreneurial finance literature, one of the explanations for the arrival of venture capital firms is that you would expect, if this is true, if the story I told you is true, that venture capital firms will be found investing at the earliest stages in hyper-uncertain, asset-specific businesses, and as it turns out, that is exactly what these guys do. Other asset-specific businesses are biotech, right? So this explains the traditional sectors in which venture capitalists operate and the traditional sectors in which banks issue loans. So we're not talking about the gap here, but we are talking about over here, you have the domain of banks, which is our canonical bake shop, our bakery. Asset specificity of our recipe is pretty easy to replicate. A lot of the, there's not a lot of asset specificity in like kneading and like doing stuff, right? Low asset specific business, and I have to buy materials that can be recouped like baking machines, bake machines, whatever they are, ovens, things like that. Go on a bakery, and you can sell them on eBay. So he's going to be happy over here giving loans around those businesses because the frontier is known, the pricing is known, there's risk and you can price it in. And if you wanted to make that an high interest rate, you could, right? In principle, price up that business. Over here on the far end, life sciences, biotech, software. What are other common, what's that? Yeah. As it turns out, right, there's only like semiconductors, into places that are incredibly knowledge intensive, incredibly asset specific. That's what venture guys do. So now you puzzle through and you go, oh, well, Rob, there's a lot of things in the world besides bakeries and biotech companies. There's a ginormous gap of stuff, like watch companies, like Zenith watches, which are neither biotech companies nor bakeries, right? These guys don't get funded for the reasons that you're describing, which is they're deeply, deeply uncertain, right? Gary's attempting to construct a new market, right? That market is unknown. The size is unknown. And although he may know on a manufacturing level how much the watches are price and cost, he has deep uncertainty about whether or not he's going to be able to sell through his channel, right? So you're less likely to invest in that guy. So this is an area, this is the great entrepreneurial finance gap, which is the most important part, which is there's lots of things served by traditional venture. There's lots of things that the loan officer can handle. But what about poor Gary and his watch company? In the area of entrepreneurial finance, where does Gary go for his financing? He can't go to a bank currently until he proves out until he wrings more uncertainty out of his business and it's more risky. Once it's risky, once it's there, then like him or Guido, right, the loan shark, right, can work it out, right? You'd be willing to give him, in principle, for a risky business, 25% on the loan, right?
Exactly.
But it's an unknown business. And I just said, and you can't go to these two guys because they say, oh, dude, why don't you go to life sciences? Where's the wristwatch? Then we'll totally invest in you. Isn't there a life sciences play in here? Right? And he goes, no, it's just a watch. So clearly there's a continuum. So the first point I'm making in my funny story is remember entrepreneurial finance is not venture capital investment. They're not the same thing, right? There's a continuum of financing options. We've only talked about two so far. You're going to tell me a few others, and then I'm going to bring these guys in. There's a continuum of financing options that starts with before the bank. It starts way before the bank and ends over there in IPO land, right? That's also entrepreneurial finance. So the continuum is, I'm trying to find a place to write, I apologize. The continuum that I've shown you here is only one small part that stretches from here all the way to IPO. IPO is financing an entrepreneurial firm by issuing equity in the public markets. That's the last stage before that's entrepreneurial finance. Private equity or mezzanine finance, which is where Ken is right about here. Then there's early stage VC, which is where Ryan is. Then there's the stuff that's a gap, right? Then there's bank loans. What else would you like to place on this continuum? Bootstrapping. What's that? Bootstrapping. Awesome. So, what is bootstrapping?
Friends, family, your own money.
Right. So, bootstrapping is none of those things.
Bootstrapping is where you get the people to pay you up front, and then you give them the product, but you're using other people's cash to finance your activities.
So, the major distinction, right, and you're right on the margin, which is we'll put bootstrapping on the far end, right? Bootstrapping is over here. For those of you who are in corporate finance, bootstrapping is just another way of saying, well, I'm going to use internally generated cash to fund my operations, except I don't have any internally generated cash, so to speak. So I'm going to go to my customers first to acquire the cash. Right? So that's that. So it's analogous to inside a firm where you're using cash from your operations to fund research and development, which is essentially, that's another conversation. The analog to this is the internal capital markets of the firm. Right? Why do firms, right? Another related question, which thankfully we only cover in the entrepreneurial finance class, is what's happening inside of the existing firm is called an internal capital market. Inside a firm that's actually working, that's generating cash, the question is, how do we go about financing growth? Do we finance growth by going to an investment banker and getting a loan? Do we, and using cash there? Do I use cash from some other business unit to finance my growth? Do I issue equity to do that? Right? Said another way, corporate finance is also entrepreneurial finance. So that's the fourth sort of joke. Your corporate finance is entrepreneurial finance. You're financing growth. In both of these cases, whether you're inside an existing firm or you're a private entity, you are trying to figure out how to finance growth. Bootstrapping, for the entrepreneurial finance guy, is on the far end of the continuum where I'm essentially pre-selling product or pre-booking consulting services or whatever it is that I'm doing in order to generate cash to fund some entrepreneurial activity that I have. As soon as you're over here, right, this is internal capital markets. It's a great point. So, but bootstrapping is not credit cards, obviously, nor is it friends, family, and fools. It's none of those things. It's something else. So what are those other things that you described? You mentioned some other ones. Where does credit card fit in here in terms of how credit cards handle asset specificity and uncertainty? So think about your credit card application.
It's debt.
What's that?
It's debt.
So
But I have a line of credit
Yeah,
with the bank, but it's effectively debt.
it's effectively debt financing, just not through
Not
through a traditional
yeah.
bank.
Yeah.
So we'll stick it here. Credit cards. Two stylized facts about credit cards for your notes. What is the average limit for credit cards is roughly $15,000 to $25,000 is your high point limit. What is the average cost of starting a business? It's roughly 25 grand, according to the panel study of entrepreneurial dynamics. 60 to 70% of businesses are financed over here. So while everyone else, so what am I saying about entrepreneurial finance before you talk to the venture guys, is that venture capital is this very, very, very small corner case of a type of high-risk firm for financing. But yet, more than half of all firms get financed using credit cards, small and SBA loans. 3/4 of firms get financed over there. So, for your notes, why do we spend so much time talking about venture capital in entrepreneurship? It has absolutely nothing to do with how firms get financed. Why do people want to know that so bad? Some more.
So if we get financing, we can start up your business.
So one reason to care about venture financing is that that entrepreneurs equivalent associated with social proof and benchmarking, right? If I receive venture financing, I'm successful. It's reasonable. Yeah, I don't necessarily agree with that, but I understand what you're saying. That's why we should care about it, right? So for your, 60 to 70% of all the action in entrepreneurial finance is all happening before you get to metaphorically tapping ventures or stuff. Like that is almost all that's happening. So said another way, Gary is not necessarily going around chasing venture financing because he doesn't fit the model, and B, that's not representative of how companies like him get financed. So there's a few other items missing from the continuum that are important to note. Someone mentioned friends, family, and fools, right? So you have the other piece of information on the continuum, usually before SBA loans and right between credit cards, is mom and dad, right? Metaphorically speaking. Right? Now we're up to like more than 70% of all financing, right?
Would you lump that in with crowdsourcing?
That's interesting. It's not on the list, and I don't. So so in this case, the question of gap. So he's already thankfully preempted me and saved you all a long set of dialogues. Right? So here's the final thing to remember about entrepreneurial finance, which we covered in Venture Trends, which is new actors emerge. Period. Fundamental feature of the world is that in this space of entrepreneurial finance, new actors emerge. So professional venture has only been around 50 years. It is a new, relatively new class of capital market actors designed specifically to finance certain types of high growth, technology intensive firms and occupies the gap where banks don't live because you can't price those pieces. Their particular interests still leave a massive gap for watch companies. Right? We still haven't solved the how does Gary Jets get funded yet. Right? He's got credit cards, he can't do bootstrapping, right? And so as a result, number 4, crowdsourcing, or crowdfunding. 2 years ago, I didn't have to talk about crowdfunding because it didn't exist. Now we get a chance to talk about it, and now I don't have to use venture capital as my story for being the new kid on the block because it's not the new kid on the block anymore. We have a new capital markets actor, which is an entity, a feature of the world, an institutional actor called a crowdfund platform, of which the business is gather a bunch of people together, get them to provide either donation, lending, or equity-based financing, and they take a little cut off the top, just like PayPal or a bank or eBay. Completely different model, completely different approach to the business, and most importantly, a brand new actor in the landscape. So the other one that is not on here is angel investors. So angel investors are not typically your mom and dad or your rich Uncle Larry. They represent high net worth individuals who are investing their own money. The difference between a venture capitalist and an angel investor, just so we're clear. We put angels here, I guess. What is the difference between these two things? Is that angel investors are investing their own money, whereas epic investors are investing other people's money. It's always cooler to invest other people's money than your own, and life is good. That is the hard difference between angel investment and early stage venture. There's one other new actor. Is venture debt new, relatively new, or is it old?
I would call it.
I'm happy to. So it's in here. There's also I don't want to muddy the water.
Are you grouping revenue based?
Yeah. So I'm not going to muddy the water. I'm just going to leave it this simple. So number 4, new actors emerge. So entrepreneurial finance is clearly not venture capital investment. Clearly not. Right? There's a continuum of financing options available for entrepreneurs, venture being one of them. That who and how these actors work depends on how specific the assets are, how much information problems there are about evaluating the business, and how much uncertainty the business is. And depending on where you go down the continuum, uncertainty, that's how to plot out each of those actors. And then 4th and finally, new financial actors emerge all the time. So just as a way of speculation, I'm actually curious before we bring these guys up. What? Because this will help you understand when new actors are showing up. So now I'm going to give you a theory of after emergence, like when they're going to show up. Why crowdfunding now? What's different about the world in 2000? What year is it now?
13.
In 2013, the first crowdfund sites show up about 2007. What is different about the world circa 2007?
Well, the finance, they came out with a new bill.
Mr. Regulation Guy. This is another. It's absolutely right. There are, by the way, several things that influence. So the question here is, right, under is, when do new capital market actors emerge? Question mark. What might I be looking for? One of the things.
Financial catastrophe.
Okay, so you've got a few. So that's great. So let's move through the list, and you're doing awesome. First, changes in regulation. Changes in regulation definitely allow the emergence of different capital markets actors. The evidence for this empirically is that if you alter the regulatory structure in other countries, if you change the regulatory environment such that it is favorable for venture capital investors to emerge, lo and behold, they emerge. They either set up shop there and start offices, or they cross-border foreign direct investment flows happen. And so that's great. The other one you just mentioned is the financial crisis. So basically, what is the underlying narrative for why you think crowdfund investment emerged 2007 forward? What's so interesting about that?
Well, I guess where I was coming from is that the financial crisis caused the regulations.
So financial crisis did cause the regulations, and there's something else going on here too.
Maybe I'm not going to answer this, but I would argue that the major players, the emerging players, are those who pushed for and were able to enact those regulations.
So on the financial crisis side, I told you that 80% of all the action in entrepreneurial finance is happening on bank loans, credit cards, mom and dad's free cash, and your ability to get companies to bootstrap on your behalf. When the capital markets freeze up, how hard is it to get a loan? How hard is it to get a new credit card? And how maxed out is your credit card trying to buy groceries? Right? Financial crises not only cause new capital markets actors to emerge, they have a massive impact on new firm formation. So you guys are intuiting that correctly. Remember, whenever you're thinking about the emergence of actors or what's going on in the world, just remember that the most important action is over here on the bank and loan side. So what are other things that could cause a capital markets actor to emerge besides changing in regulation and financial crisis? I also heard the embeddedness of social media. I heard someone say that. So who's that? Yeah. So what's that? What do you mean by that?
Well, there's like a new avenue to essentially advertise and market your idea instead of going with a prototype to a bank or a VC or an angel investor. You can say, hey, we have a project, we have this, and we want small players rather than one VC to fund us. We want 1,000 mini VCs to fund us. How do you access those sources of capital prior to social media?
Right. So said another way, both the amount of technical infrastructure in a country and the level of pervasiveness of the social graph is going to directly influence whether these sites are launching and flourishing. As it turns out, I just ran some regressions today on a data set related to this stuff across countries from 2007 to 2013. As it turns out, one of the biggest levers is whether or not grandma metaphorically has a social media account, how embedded and taken for granted social media is in a country, because remember, this stuff is all happening by trust. And so you have to remember 6-7 years ago, people were all bent out of shape about online privacy. Right? I don't hear that very much anymore. People sort of get episodically bent about it, but the truth of the matter is we're happy to post pictures of our kids pooping online. And, Strava shows us where we, our workout log shows where we live. But we don't care about this stuff because we just trust. We have a level of trust and acceptance of these embedded technologies that allow for that actor to emerge. So the only point I wanted to make here, right, is that these actors do emerge. that it's possible to look for visual cues in terms of technology, the status of the capital markets, and the changes in regulation to be able to tell what's going to happen, just as an aside. So with that, bet you're tired of listening to me talk about entrepreneurial finance. So why don't we break to, can I read you guys' bios while you're up here? So this will be really fun. So now you can see what it takes to be a venture capitalizer, right? So this is Ryan Hemingway. So Ryan is from Epic Ventures. So he's an associate. So you have to ask him what's an associate? What does that mean? He's an associate with Epic Ventures. Started his career at the Zions Bank Capital Markets Group, that bank, chasing trading repurchase agreements. Then went to go be a corporate bond trader, which I think is pretty interesting, and did a ton of risk management on corporate bonds. So you know the distinction, you know the difference between risk and corporate bonds and uncertainty. We can talk about that. Then you did a bunch of M&A work and worked at a small trading firm in London.
We purchased a small trading firm in London, which was a disaster.
Which was a disaster.
That it should be a case study. On paper, it was everything just should have been perfect, and it was a disaster.
So why did you? So I'll be interested to know why. Tell me why you came back here, and I'd also like to know. So we had his underlying training, which is, by the way, not uncommon for most interesting venture guys in the early stage field. Is he has experience in finance, but he's trained as a psychologist and has an underlying MS in econ. So psych, econ, not finance. Although you do have an MBA. Did you get your MBA before or after, or is it just sort of an after effect?
That was after.
So training. So
Science.
So then there's Ken. So Ken, you're operating partner at Mercado, right? That's the official title.
That is the official title.
So previous to Mercado, which is a venture capital, actually later stage venture capital firm located in Salt Lake, Ken was is it fair to say part of the founding group, or were you an early member of East Spring Capital?
I was one of the original limited partners.
Okay, so that's even more interesting. So Ken is explain what is a limited partner. So Ken was an original limited partner in V Spring Capital, which was one of the first early stage venture capital firms in the state of Utah, and then served on several boards of companies while you were at V Spring. Is that fair to say? And then ran off, left V Spring, and formed Mercado with Alan Hall, Greg Warnock, and there was you. And was there anyone else on the team when you guys did that?
No. For those of you who had classes with Joe Grover, who came on pretty early.
Yeah. And so there's interesting conversations to be had about like how these firms get formed, what forming a fund is like, what it's like to treat a venture capital firm as a startup, because it was, right? And prior to that stuff, Ken, like me, is an ex-old school venture-backed startup guy, where we sat on the other side of the table, took venture guys' money, and then built large companies, and then spent all the money on special machines, and then went out of business, and it was awesome. We did really good. So, there are your resources to talk about. Now, I've sort of dispatched venture, but now you can talk. Now that I've described it as the least interesting part of the entrepreneurial finance continuum, what would you like to ask our good venture capital friends? Or what can they tell you that would help you or inform you?
Ryan, are you doing early, or does Epic do early?
So we do typically A rounds. Are you guys familiar with A, B, C rounds? So typically, if it's really early company, it's just the idea stage. You probably get angel money, which is angel money, family and friends. You kind of build out. Generally, you have a beta. You've got something built. Sometimes you have revenue, but not a lot. Then you raise what's the A round, which is where we come in. We're usually the first institutional money. That's where we like to play.
And just second part, Ken, I'd be interested to hear your transition from early to late? What prompted that? Why?
There's a handful of ways to tell that story. Probably the most interesting way is to say that early stage venture capital fell a little bit out of favor. So V-Spring Capital's first fund was raised in 1999, and the money was spent later in 2000. Why would those years be interesting? What happened in 1999? So what happened with
Changes in regulation? No.
Everything's
Yeah, well, so the bubble burst, right? So V-Spring had a decent tailwind in the sense that they raised all this money before the bubble burst, and they got spend it after the bubble burst. But they were doing early stage investing, and early stage got a little bit out of favor. And I worked specifically with Greg Warnock, who wanted to do later stage and expansion stage work. And so Greg just negotiated a way for him to split. And since I worked with Greg, and I believed in this expansion stage theory, I left with him to go out and start my company.
So two guys, one doing very early stage. So in the world of A, B, C, D, E, where do you guys show up?
We show up pretty far, to the right on this continuum. Mercado takes investments that have, $10 million in trading. So, by your standards as entrepreneurs, they're pretty good.
So most investors, they ask for about the secret sauce, and VCs, they also ask about the secrets, like why you as a company and nobody else. When it comes to IT, what the secret sauce you're looking for, given that I heard from a lot of investors, when you tell them, well, we have a patent, they tell you, well, we're not interested in a patent war eventually with some other company. So what is the secret sauce you're looking for?
First, how much, why I brought early late? They're different, right? We tend to treat venture as a homogeneous lump in which we make claims about what venture people do or don't do. I'm not picking on you, I'm just using this as a cognitive lump. So we're going to cut this in half, and now we have early late. How much do you care about secret sauce?
So I have a personal theory. I actually don't take a lot of stock in intellectual property. I think it's great as an investor to have some sort of freedom to operate and understand that the company's not going to run afoul of somebody else who's prevent them from doing what they're set up to do. I think most of the successful businesses are built on execution. That said, Mercado's philosophy as a late-stage investor is less about intellectual property and defending this. I mean, very few people actually get to litigate their IP. But Mercado's philosophy is Mercado invests in businesses that already have trading revenues and have this defined product, and Mercado helps them take their products into related markets. Right? So they're not actually looking for you to do something significantly different than you're already doing. They're looking to give you money, do the same thing you already know how to do, but you don't have the money to do. Which means the valuations on those businesses, those valuations are worth a lot more than the companies that Epic's investing in, and therefore we get a lot smaller percentage ownership in those businesses, but appropriately our risk should be lower inside those businesses. But to go back to the original question that you asked of how do you know what the secret sauce is, usually you can go to the website of the investor and you can read what their secret sauce is. They will say, we care about these 5 things, which implies there's a couple of other things that they care about. Most firms you can find out in advance what they care about, and you should if you're going to meet them.
How much do you care about defensible uniqueness? So Ken doesn't care about uniqueness. Do you care about uniqueness?
We care about it a lot.
Why?
Again, because it is defensible. But so here, this is just how I think about it. So we all, as an MBA group, right? You've heard sustainable competitive advantage. Now I'm of the belief that, and I could be wrong, so you can add it if you want. I don't actually believe there's any advantage that's sustainable forever. I kind of look at it and I have to admit I've stolen this from Rob Ryan, who was the CEO of Ascend. If you got 12 months that it would take for someone else to replicate it, that's about as good as it gets in the tech world. And that's how he grades it. Do you have a year? Do you have a year ahead before anyone else? And anything less than that is just a variation. So, if you get someone, which we have, that says, hey, yeah, we built this in 48 hours. This is going to change the world. No, it isn't. Because if you could build it in 48 hours, so can 4,000 other people in 48 hours. So, that is unique to us. We look for that.
Good. Two things emerged out of that question that I want to highlight, course, for you guys. The first is venture is not a heterogeneous lump, that each firm is going to specialize often in a specific industry or specific time frame or life cycle, and that's going to influence whether or not you should approach them or not, and it's going to influence, if you do approach them, how you're going to message that. You certainly wouldn't want to talk to Ken about the amazing secret sauce you have when you fall asleep. Guys, you might be interested. The second thing I wanted to highlight is how we're hinting now at, so he handles risky businesses, interesting, and he will have a different set of analytic criteria that he uses to evaluate them. Because Ryan spends his entire life evaluating fundamentally uncertain businesses. And what we know about how people evaluate or function in the world and that dealing with uncertainty in terms of what cognitive science says, is that we tend to use don't hear this as simplistic, simplifying heuristics. And he just actually gave you one that's probably operating in the background in every, and this isn't entirely true, but behind him, right, if you went and told him that it took 48 hours for you to build this thing, right, he would not be interested in that, because he has a rough and ready decision heuristic for evaluating their companies. All these other things like trailing revenue and cash flow, he can't say anything about that. He doesn't want to deal with that at all. It's a very simple heuristic. Did it take him less than 12 months to build? Yes. Probably sucks. Might be willing to learn more. Maybe not. Took longer to build. I'm sort of interested. Right? Heuristics are how humans function in an uncertain world. And the vast majority of decision research on venture capitalists, academic research, focuses precisely on these simplifying heuristics, of which he just gave you one. So, parenthetically, for those of you who are about to ask the question, how do you evaluate firms, right? There's the published list of things that represent the checklist that he uses to evaluate the firms. And there's probably, in addition to that, a set of probably very potent simplifying heuristics that he uses. And it'd be very important to understand his simplifying heuristics in order to effectively pitch it. And how can you find out about your simplifying heuristics?
Just come to this class.
Metaphorically speaking, you have to get to know him. You have to build a relationship with him.
Well, I'm kind of going on that.
Yeah.
How long do you, I guess, each kind of work with entrepreneurs before they get funding? I mean, give us an idea of what that's like.
I dare you to speculate. So speculate for me. So two guys, two different stages of the equation. How does he handle working with entrepreneurs? How does Mercado handle working with entrepreneurs?
I think relatively, I would imagine is a lot longer.
Why?
Working with prior and then Kent. I don't know, maybe 4 months, 5.
So that's really interesting. So I actually don't know. So how much time do you spend working with individual entrepreneurs and nurturing them?
I mean, the sad answer is it depends, but it's been anywhere. The quickest I've ever seen us fund something was 2 months. But we still have things we're looking at a year later. It's just, so you've heard management team. This is another one that we look at as a management team. How, what are they? And there's one piece of that which is the resume, right? Hey, I went, I'm an engineer from MIT, Stanford, blah. I mean, that's nice, but one of the things that we watch in that year is okay, what are you doing? How are you approaching this? What are you doing? I'll give you an example. There was an interesting one I looked at. I liked his idea. He had a pretty good idea. He had a really interesting back-end piece to it for restaurants. And I told him, I said, hey, I like this. It's interesting. I said, let's touch base in a couple months. He had a few customers. I said, let's touch base and see where you're at. So we touched base, and I think 4 months later, and he'd added like one customer. And he said, yeah, so let's talk about funding. And I said, you haven't done anything. And I'd follow up. I'd watched on his site, and he kept having all these free iPad giveaways, and he had all these gimmicky things that weren't working. So in that year, one of the things we're watching is, what are you doing? What kind of decisions are you making? Are you, You know, are you being creative? Are you thinking outside of the box? Are you doing something that's showing me that, hey, I'm going to make this happen? There's another heuristic.
And these are beautiful, right? So these are not necessarily uncommon. Right? The point I really am thrilled, right? I just wanted to get at the fact that Ryan, as he's talking, is going to unpack for you a series of heuristics for how he evaluates businesses that are slightly idiosyncratic. They're slightly firm specific, right? Because you have a culture inside the firm that you guys are going to think about things the same way. So it's important to understand that. And at the same that the investor is observing you, right? While you think you're doing whatever you're doing, right? You should have heard like, let's touch base. That didn't mean that he ran off and forgot about him. He actually visited his website a few times in the intervening period. While you think you're off doing whatever you're doing before you're retouching base with him, he's already retouching base with you. He's looking at what you're doing. He's doing diligence on you before the diligence has started. That's the lesson there. You've already lost. You're in a race. What I'm trying to communicate is you're in a foot race, and you don't know that you're racing, and he's racing with you.
But this is now getting confusing. I got corrupted by the success equation and thinking fast and slow. When you talk about these heuristics, how objective are they, and where do I fit on being lucky that what I'm saying, my attitude, my charisma, whatever, is hitting home run versus what I'm actually doing, which can be objectively measured. I mean, these heuristics, apparently we fall victims to our intuition.
There's a fair amount of the academic work on what's called homophily, which is why do Ryan and I like each other? Because we think the same way. We approach problems the same way. We're creative and flexible. When I hang out with Ryan, he is clearly he's a person who's really interested in imagining first the possible world before critiquing it. I enjoy spending time with him because he allows that to be. There are other acquaintances that I have that are less counterfactual in terms of their thinking. I resonate with them less. Right? So the data show that in investor and venture setting, our plotted similarities on a series of personality prototypes are going to influence his willingness to fund them.
So what you're saying is that everything on paper could be fine, but if you just are not jiving with the team, then
what I am saying is I am saying that, but what I'm more precisely saying is there's a fair amount of research on the decision biases in venture capital investments. You just go Google that, and you'll get a shit ton of papers, including mine. And what you find in that literature is that there are two things, right? Biases and heuristics. Heuristics are simplifying mechanisms that human beings use to deal with an uncertain, chaotic environment. He's actually aware of his heuristics, and he could update them if you wanted. Right? You could change one of those heuristics. You go, that heuristic is dumb. I'm going to change it to like 18 months. Right? Things have changed technically. Blah, 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 right? A heuristic can be updated. Biases, on the other hand, are often largely preconscious or unconscious, and cannot be worked around by deciding to think differently, because you simply cannot. Of a class of biases in the world, homophily bias is one of them. And as you say, he likes me more. Where likes means if you give him a Neo-FFI, which is a 5-factor model of personality test, you give him a personality test thing, and you give me a personality test, the degree to which he and I's personalities overlap creates homophily, and that homophily will cause him to unconsciously be more interested in giving me money. That is what I'm saying, because that's what the data show.
So it's not just about finding venture money, it's finding the right venture firm.
That is the conclusion that one can draw from this conversation around entrepreneurial finance, which, by the way, broadly relates to loan officers and anyone else that you're interacting with. It is often not the institution, it's the person within the institution, right? And there's a random effect that relates to, as you say, the level of synchronization you have.
Just add on that point, and maybe some of you have this, but we've noticed this. We're in these firms for a long time. So back to this point, the entrepreneur may think that they've got everything on paper, but if we don't really want to work with you, And we're not going to do that because this could be 7. I mean, we just exited a company we've been in for 14 years. I mean, so occasionally you just meet someone and you go, I don't want to work with them that close for 14 years. And for an entrepreneur, even if you've got a great idea, really, there's nowhere to go there with VC. So, I just don't work. And they probably wouldn't tell you that to your face.
I was going to say, I really appreciate your candor, right, because this, hopefully this is new, non-blog worthy. Right, what we're trying to do is have a conversation that's outside what you're going to get on YouTube and outside what you're going to get from blogs, because we're being informed by the literature on decision making. We're around 2 exceptionally honest individuals. And so while he's hearing your pitch, he is imagining 5 years in the future sitting on your board and having to deal with that relationship. And he's asking himself, do I enjoy, am I resonating with this person? Is this team coachable? I might even ask some questions to see whether or not they're coachable or not. Because there's nothing worse than being a board member on a management team that's utterly uncoachable. And those things are going to play, I'm guessing, a major role in your decision. Now, less so for you. Why?
Well, and one other point, the converse is also true, right? As an entrepreneur, you should be interviewing the investors. You might say, oh my gosh, I cannot imagine going to board meetings and having this guy run the board meeting. I will never take one.
Yeah. It's like a dating, right? Yeah, it is a two-sided matching process.
It's more like finding a.
I was going to say there are venture capitalists who have a dating site that you can go and find one and see if it can happen.
Yes, yes, there is.
It's something like Match.com.
Yes, exactly.
No, there is.
It's Craigslist where you might.
It's called The Funded. So this thing is called The Funded. So I am not suggesting in any way that the detail in The Funded. Actually, the detail in The Funded is less like a dating site and more like Yelp, which is all that entails. Right? The downside of Yelp is if you're in an environment, in a food environment, food culture that isn't very good, right? You end up with Yelp reviewers that don't know anything about food and they care about like a bunch of dumb stuff and you can't, right? So The Funded is like Yelp for venture capitalists. You have to apply. It's an application-only site, is still thing. And you have to apply. If you get accepted, it has a bunch of venture capital firms and founders describe their experiences vetting seeking money from different venture capital firms. So you go to The Funded right now, probably query Mercado. There's probably something about Canada, what it truly is. I can probably look it up right now. And the ratings get uploaded and downloaded, right? And they relate a lot to the salience and usefulness of the feedback. Is The Funded still up? Are you guys looking? Is it still there? Yeah.
Last I checked, I did not have feedback.
Right. So I'm not arguing that The Funded's feedback is accurate or meaningful. It's just 1 or 2. Unfortunately, it's a small sample size. A couple entrepreneurs' experience, but there's something useful about that. That there's more transparency than ever before about taking financing, and one should deeply consider, if you're going to take external financing, whom you're working with, because it is a 7-year interaction, and it can be very unpleasant.
And we give every one of our companies we fund references. We encourage them. Go talk to all these guys we funded. Feel free to pick a company and we'll introduce you. You should be doing that.
I don't know very much about this at all, so I would be just interested in hearing like what the scope of what an associate does or can as a partner. Like what the scope is of what you do. You bring your ideas of good companies together with some other people that you're working with inside the company and make group decisions on how to fund. How do you decide what kind of quantities to give? Who pulls different strings? Like what exactly is all working inside your organization? How does it look? How does it work?
So I can tell you about Epic, and again, every fund is different. So we're a little bit smaller fund. So the fund, we're raising Fund 5 now, it's going to be $75 million. We have 3 managing directors.
75.
So we have 3 managing directors, they're the partners. And then, I mean, technically, I think other firms, I don't know how it goes, principals, seniors, so I don't know. Anyway, we've got the 3 managing directors, and we have associates, 2 associates, and an analyst. So it's a very flat organization. So I'll just tell you, what I was told when I got there. But a venture capitalist does three things. We bring in new deals, we manage our portfolio companies that we have, and we raise money. So every minute of every day, that's why I spend in one of those three areas. Now, finding new deals is the most fun. Working with companies, if they're, that's pretty fun. That can be pretty fun work, unpleasant. And raising money just is unpleasant. So that I spend my day doing that.
So you yourself are busy raising money, just like
I make calls and I visit.
And you're raising money from whom?
Our fund, we raise mostly from institutions. So our biggest investors are state pension funds. We have in about 5 states. With pension fund money, we have banks, a lot of bank money, and then odds and ends individuals. But those are the
I actually like raising money, but I mean it's the same. It's the same group.
I don't like raising myself.
You're looking at new deals. You're selecting a deal, maybe to add kind of a sub-step. Then once you are in it, you're managing those deals. Managing those deals includes things like selling those, deciding when to get out of those deals, and sell those deals. And then you're raising the capital.
So the skill set that you would need for selling deals involves, what exactly is that?
Well, traditionally that's an investment banking role, right? I mean, if you have a company that's a $100 million valuation type of company, you hire an investment banker, and they go out in the competitive bid process, and they find a bunch of in-industry strategic people that they can sell to. They find a bunch of potential financial buyers that they can sell to. They might even think about taking a company like that public, and you'll hire them to do a lot of those. I guess if you were really big firm, you could have a former investment banker, M&A guy on staff, but most people don't. So, when companies are smaller, there's a lot of downside situations where it's not as much fun as I make it describe, right? You're like, all right, this company can't make payroll. How many people are we going to fire? What's the order in which we're going to fire them? How do we, what kind of severance do we work out for people to do them? What's our relationship with related parties or other fund investors? There's a lot of unfortunate things about some of the exits, but for the most part, they're good.
So, and on the due diligence, though, Ken's due diligence packet is probably mountains of work, right? You've probably got, they have financials and just oodles and oodles of data. Our due diligence, we have a joke internally where we say, the more data we can find, the probably the worse deal it is, because people know too much about it. So a lot of our due diligence is, we're on the phone calling people in the industry that we know. So I get a lot of calls or from students that, hey, I'm a finance grad, I'm really interested in joining and doing some analysis, and I've never done a discounted cash flow loss. We don't do discounted cash flows because a lot of times there's no cash flow. It's negative. We're not digging into that. We don't do that. So you do a lot of market research, but a lot of calls. So a lot of just your network. You call people that know that industry. And hey, is this a problem? What do you think about this? What do you think about this solution? If this were available, would that be interesting? Would it not? What would you be willing to pay for that? And there's a lot of that. So our due diligence is very different probably than what Ken does.
That's a great point. So again, 2 different sides of the equation, 2 different. It doesn't in terms of effort. We assume it's equal. But one's a lot of math and dot box checking. The other's a lot of telephone calls and deep thinking. But fundamentally, the diligence processes are idiosyncratic, right, between these two environments. And his is much more about. And said another way, if you have done the product market fit stuff that we talked about in week 4 or 5, where you're talking about doing customer interviews and getting on in the bus. I actually wasn't here in this class, it was the Venture Trends class where the guys from Domo talked about getting in the van and driving around, right, and interviewing people. Right? He's essentially doing that for you. This is why the Frank Robinson stuff, like the product market development stuff, is so attractive, because Frank is merely aping on the front end what these guys will be doing for you in the diligence process. So it's as if you're a smart person coming in and saying, I made 50 phone calls and customer visits to all the people, some of which might even be in your network, you know, right? And this is what we found, and this is a problem, and this, if the solution were available, we would want it. It's much more likely to give you a listen as a result. So it's just interesting, right? That at the end of the day, the numbers and all the other sorts of stuff that you would imagine in a business plan is going to be less potent, and in fact might even be repulsive to Ryan, where if you just gave him a list of 70 people that you called, and you can look at them and go, oh, I know those 3 guys in that space. I'm going to call them too and see what they had to say about it. Oh, I met them and it really works. That matters.
So typically, I look at a venture funding type project as I'm going to be kind of bowing down before you guys and asking for your blessing. How often are the tables turned where you're competing with other companies for this one single great idea, and how does that go, or does it happen?
Oh, it happens.
More often than not.
Yeah, more often than not. You know, if you've ever listened to Josh James, you know, and I've been waiting for the question to come up, and hopefully it doesn't, but maybe it will. Josh James. You know, how does a company get funded? How do you get VC capital, right? We joked about this earlier. You know, Josh James will tell you, get a good company. So good companies get funded. If you're not getting funded, then your company sucks, right?
Or it's inappropriate.
Or it's inappropriate. So yeah, there's plenty of times you get you know, deals that everyone's competing for, right? And it drives the price up, and you know, it just depends. I mean, we have a pretty good reputation. We work with a lot of firms in Silicon Valley, and you know, so we do get, you know, where we do a syndication and be a part of it. You know, I'll be honest, we've been we had a great deal that we were good friends with, and he said, hey, I want these guys to be in, and it happened to be a big name firm that everyone recognized out of Silicon Valley, and the guy said, you know what, I don't want anyone piggybacking on all my great work, so I don't want him to steal it. In which case we didn't get him. So, you know, it's no different than anything else, right? Some people are jerks, some people, you know, a lot of firms are happy to say, hey, yeah, let's all take a part of this, and others just say, no, we don't want to.
So another important component of this is the notion of syndication. You guys are aware that venture capital firms typically do not invest alone. They roll with a posse. Right? And so he just described a syndicate arrangement gone bad, which is I really want famous heavyweight VC at the deal, and high reputation heavyweight VC says, I'm not interested in sharing this deal with you. Maybe he has some other pals, syndicate pals that he works with. How often is it the case when you're doing a deal that you're doing, how often are you doing a deal with repeat entrepreneurial offenders, like serial entrepreneurs? And then the other question is, how often do you do deals with repeat syndicate partners, individuals with whom other venture capital firms?
I mean, all the time. I mean, I don't think, I can think of one portfolio company right now that doesn't have other VCs involved. You know, a lot, and I refer to VCs, a lot of them always have angels and friends and family. We rarely see a deal that doesn't have that kind of funding, but like I said, I can only think of one where we're the only VC, so that's rare. And then as for serial entrepreneurs, I mean, yeah, that's pretty common.
So
we back, I mean, In Structure, if you know that one, that was ours. Josh Coates, we backed in Mosey. In fact, the true story behind that is he came and said, hey, I love this idea. And we kind of said, all right, because it's Josh, here you go, here's some seed. We did the seed rounding down, so here you go. But there was at one point we thought, man, what are we doing? Yes. And, you know, that's worked out well. But again, we did it because of Josh, which we backed before.
So so the venture literature suggests that suggests two things. First, the empirical findings suggest that venture capital firms inordinately invest in individual entrepreneurs that they know, or know means in my region, means I visit them and see them a lot. A lot of the information problems about them are resolved. They also disproportionately invest in repeat offenders, where that means serial entrepreneurs and individuals that they've backed before. And the literature also says that they also, their co-syndicate partnerships are often with the same venture capital firms over and over and over again. There's some evidence, most recently, that that's not so great. There's a great article by Josh Lerner, it's Josh Lerner called the price of friendship, which basically tracks the syndicate relationships and the investment relationships of venture capital firms and demonstrates that there is a negative relationship in some cases between them happening. We often talk about the positives, but there's some negative stuff.
So, for example, you're part of the DFJ. You've worked
We were
with.
the first group on that.
And are you saying that sometimes you just kind of get locked in, or is that more of a fluid situation?
It's a locking effect according to the
But also there's informal networks and informal
Totally.
buddyships.
Oh yeah. I mean, Tomorrow Ventures, we've done 3 or 4 deals with them, and they were doing what we started with them. We worked with Intel Capital a lot, OpenView a lot. I mean, they're all kind of and that's part of the due diligence process as well. I mean, a lot of these guys are seeing stuff and call them up and say, hey, I've got a great deal. Would you take a look at this and take a phone call and meet with this group? Tell me what you think. I mean that goes on.
So these nested relationships suggest that the due diligence process is all happening on the back end, largely unseen, largely long before you're pitching. It's conceivable to imagine, we'll use Tomorrow Ventures as an example, that long before you ever took a meeting with Tomorrow Ventures, they already knew about you, saw your pitch deck, and talked to Ryan about the business and gave him advice long before you showed up. So the short answer, right, for an MBA, and this is learned from my mistake and Ken's great victory. So Ken is a shining example of everything there is to be done right in Utah and in the ecosystem, because he has, if you drive up the avenues and drive up further and drive up further to the top and then go further and then get on a helicopter and go up to the top of that and then get on the special escalator, that's his house and it's freaking massive. He's got like 18 cars and a Bentley and like a heliport. Great decisions, because Ken has lived in Utah and he's been a decent human being to everyone. People, even he's able to say no with grace and aplomb. As an entrepreneur, he didn't do anyone wrong. As he didn't treat anyone poorly. He's not an abrasive personality. He was a lovely guy, right? Me. Bottom of the avenues, keep going to the bottom, go down to the dirty part, then go down even further, then turn left to the shithole. 400 square foot apartment, right? Dirty, filthy, there's ants in my apartment.
There are ants in your apartment.
Yes.
I will, that part is true.
Yeah, there's ants everywhere, right? And like it smells sort of bad, and I live in sort of this anteroom piece, so it's like humid and kind of sticky and hot and horrible all at the same time. And you know, I had 2 decades of work in this environment where I was a notoriously terrible person to work with and for. Just terrible. Terrible to work for, terrible to work with. You didn't want me anywhere near the board because I was aggressive and unpleasant. I was aggressive and unpleasant to my employees. I was aggressive and unpleasant at the top management team level. I was only tolerated because I could do special things with code or whatever, right? But I was just a horrible human being. And so, as a result, it took 5-6 years of Ken's help when I came back to Salt Lake. When I came back here, and I was like, we'd go to entrepreneurship meetings, and people would literally pull Ken aside and be like, what on earth are you doing hanging out with that D-bag? I can't believe that guy's back in town. Like, I thought we got rid of him, like, in 2002 when he left to go, be in California. And Ken's like, no, he's different now, right? His medication worked, like, he gets some lithium down, right? And, like, he spent 10 years, like, in therapy, and, like, he went to the Scordian analysis guy in New York, and, he doesn't, and they're like, look, I heard that guy, like, threw shit and threw a monitor at someone and kicked over, like, 10 cubes and, like, took a giant dump on it. I heard some terrible stories. Not a single chair has been thrown. He hasn't taken a shit on anyone's desk recently, and he is a good man. And it took, I would say, 3.5 to 4 years of, and I'm being funny, but I'm not. I'm not being funny. It took 4 years of concerted effort when I got back here in 08 and 09 to create a listening in the entrepreneurship and venture environment where people would be willing to allow me to help. I wanted to come back simply to help. I wanted to come here to make a difference. And there was no difference to be made because there was no listening for me in which to work. So all those interrelationships actually matter. And if I were to go do a diligence call on me and call like people I work with, I'm sure you have, right? You'd be like, oh my God, that guy is a great investor. Like I work with him, this is incredible. And it's true, right? It's all true. Every last bit of it is true. And all of it will impact, if I were an entrepreneur seeking funding, it would impact who I got to work with, it would impact the board members I got, it would impact whether or not I got invested or not. And you have to have, even though it's kind that people like Ken and Ryan will hang out with me for fun, right? There's still a fair amount of radioactivity attached to me, right? And so, even so, it creates, winds, what do they call it? Headwinds, right? Funding headwinds. So, wherever you end up going as an entrepreneur or a business person, don't burn any bridges, be a decent human being, learn from my mistake, be a good person. Like Ken, and you'll end up with like good benefits. Helicopter.
So Domo announced recently that they raised like 56 million. Is that right?
And you invested. Did you invest in this round?
We did not. No.
So you
that's way out of our range.
So they didn't invest. So it's out of your range. What does that mean?
So that's my question. Is I didn't know if that's a lot or what's like a.
Well, the valuation.
More than 100 times trading revenues is how you're.
Yeah, that's a lot. So we play in the early stage. Like I said, we're a little bit smaller fund. 75
Just
small,
love
but,
like it's just
but
peanuts.
we do. So we invest anywhere from $500,000 to like $3 million in a round, and then we save for follow-on 2 or 3 times that for follow-on. Now, every entrepreneur will tell you, I think we'll be break even with this one round, and that just goes in our ear and out. And we know that's not true, but then you hear that. So anyway, we say that. So if like where Domo raised money, whatever it was, at $200 million. I mean, I don't know what it was.
Ken, do you know what it was?
Anyway, it doesn't matter. For us to invest
in Domo.
For us to invest $1 million at that level, it is we would own
0.001 share,
and you would have to sell that company for $1 billion plus, which our risk reward ratio that's hard to do. Like a better example than Domo, probably real quick, if I can tell it quick. We were looking at a company out of Chicago that was introduced to us by one of our firms, our CEOs. Really cool marketing company, great. They had 3 or 4 million in revenue, just growing. It was great. The team was great. When we got further into due diligence, we realized that they had raised already $12 million. We were probably ready to invest $1 million or so. They had raised $12 million. And their pre-money valuation is going to be at about $50 million. And we know that space very well. We, again, talked to a few others in that world, and they said, you know what, this company is going to sell for $50 to $100 million. So for us, hey, if we invest $1 million now, the best that we could hope for is 2 times our money if it sells for $100 million. So that, again, that's just out of our range. Where that's one where we liked the product, we liked it, we liked the team, we liked the space, we liked everything about it, but that just the metrics don't work for the way we do things.
So, follow-up question: for each of you, what is a good deal? And then I feel like I've read somewhere that you expect so many bad deals, 4 bad deals, and the 5th great deal pays off for the rest of them. Is that true?
Yeah.
Well, it's easier for me, right? I mean, when you hear somebody saying, like, we want our companies to return 10 times their capital, Mercado never looks at deals that return 10 times their capital. I think Fusion and I return 15 times, but that's really unusual. Usually it's quite a bit less, but we don't have that many deals that fail either because we're investing relatively late in their life cycle. They already have this set of trading revenues, and they're not launching new products and tackling new markets. I mean, this business is relatively established by then.
So all the heuristics that you read about on blogs about how things are supposed to work, none of them resonate with that guy. How about you?
Yeah, I don't know. I mean, I don't know what the exact statistics are. I guess I've never done one, but yeah, you've got a bunch that fail. We've historically had a 120xer in every fund at least. We generally look. We try to swing for the fences, right? We know that we've got to have those, so we look at stuff that could at least potentially. I mean, I think, I don't know, you probably know the studies, but the studies show that most firms sell from between 80 and 100 million, around 100 million, I think, is that right? The majority of firms that are funded by VCs sell for about 100 million. But we invest at least with the potential that it could be a lot bigger than that, because we need to have it. So, I mean, 10x is, a lot of entrepreneurs come with that too and put that in their pitch deck,
So
right? We're going to return 10x.
All you just said there, you just said, I can read blog posts.
Yes.
I don't know anything about venture. I don't know anyone in venture, because I would never put that on my slide deck, because that's not the issue. The issue is that each one of these things, if it's not potentially going to return 100x or 20x, or like it's not some massive win, it's not interesting. So you just have to.
But then when you turn the page on that slide deck, it says, if I just had 1% or half, 1/10 of 1% of this market, I would be
That's a
$50 billion business.
That's an MBA thing. You know, you see. So we just to give you an example, I probably see 30. Just me personally, I probably see 30 business plans a month. So you see a lot. But yeah, the MBAs usually have the ones that are. Forrester research shows this data, and they just have a lot of data points in there. That's a typical MBA. Just fine. Don't. It's okay. I'm not arguing, but yeah.
For the ones that you don't have any background with at all, how do they capture your attention, or how do they come across your desk?
So we have just a general information line that people send and stuff. So we get them that way, and then mostly through our networks. We're out. We're talking with other entrepreneurs. We're talking with other funds. We're visiting. It's just a networking thing.
So if you were listening, the deal in Chicago was a referral from the CEO of their portfolio company.
That's what I'm saying, but what about the ones that you have connections,
They
Just go right in the garbage.
They go into the garbage can.
I literally looked at 1,000 deals a year.
But there's two ways to look at this. I think the first way is to be frustrated, which is like, this is a rigged match. It's such a bummer. These guys, they only do deals with people that they know, and you have to know someone, and I don't know anyone, and that's really frustrating. You do know someone, actually. So there's two things that are interesting. You guys actually know two venture dudes now that you did not know 2 hours ago. And not only do you know them, it's clear when you talk to them, part of their whole job is to go out and find deals. That's one of the 3 buckets that they're in. So they're active in the ecosystem and around. You can spend time with them. You really can. It's not like they're too busy for you. You are the thing that they're supposed to be doing. They don't want to run into you when you have a business plan. They want to run into you over dinner, at a networking event where you're not pitching them some dumbass cold fusion thing, right? Do you follow the reasoning? And I really, really mean this. So let me tell you a story about a guy who wanted to get to know Ken Kroll as a venture guy. This kid was an undergraduate in one of my classes, took me seriously about like, look, do you want eventually to get invested? Like these are like diaper baby kids. I was like, okay, great. Do you someday plan building a growth company? You need to build the obvious inference is you need to get embedded in a network. You need to start networking so that people will refer you. And you need to start finding and getting in front of venture guys in ways that allow them to observe you over time, in ways that are not transactionally oriented. The last thing I want to do is have my first meeting with you cold, right? And the second worst is a warm introduction from a friend. What I want is, metaphorically speaking, heralds to be blowing the trumpets about like, have you met Rob Webker yet? He just showed up in the ecosystem. Yeah, I heard he's a douche. No, he's actually great. That's the negative version of the herald, right? But you want the positive version, which is you want him to want to get to know you, meet him socially, and it's awesome. So this little kid, how did he have breakfast with you or something? Or how did this work? How did Travis end up wiring your house? How did he end up worming his way? So this kid figures out a way. Does he send you an email, or how does this happen?
We're just hanging out at some sort of event, and Travis is like, hey, I got some free time, what are you working on? And I say, well, I'm working on my house. And he's like, all right, I want to come work on your house. So I'm like, that's great, because you're about 80 pounds lighter than I am, and I got this crawl space that I can give it to you.
So that's how Travis Corrigan and Ken Kroll, who are now friends, their relationship started, which is like, oh, we're at a networking event, so what are you up to? I'm wiring my house. Oh, that's super sweet. And Ken's looking at this kid. He's like a beanpole. He was like 130 pounds. He's about this high. And he's thinking, And this kid's like, yeah, I'll totally help you wire your house. And Ken's like, oh, hell yeah, I can use you because you're small. And they wired his house. You guys have been friends ever since, and now you know VC, and through him, he's embedded in those networks. And the wiring house story is funny, but it's also not, right? That metaphor is how life works. You develop personal relationships with guys in the venture community and CEOs that pay off into jobs. They pay off in a number of ways. One is he's probably one of the most highly connected. You know who's hiring in every high growth firm in Utah, period. Yeah. You want a job? He's your guy. He knows who's hiring. He knows which companies actually don't suck. He knows which people are good to work for. He knows even better than which people are good to work for. You can go to him and say, what an awesome, by the way, you probably need to flood with meeting requests.
It's just say, all right, I might not be able to.
Right. But like, he can sit with you and go, I'm going to get my MBA. I know that after this is done, I need to get imprinted. I know I want to learn. I'm willing to accept less prestigious work to work for a world-class manager. Do you know a world-class manager? And he'll go, I am too. And let me get to know you a little bit, and maybe I'll refer you, right? Because you're not going to refer them straight away because you don't know these guys, right? He knows who to hire. He knows who to work for. If you tell him what you want to learn, he can put you in pole position to work with someone who can teach you that. He's your best friend. And yet, despite that, I'll bet you're lonely during lunch sometimes.
Not very much.
But you're lonely a lot.
You'd be surprised how many. You'd be surprised how many people don't follow up on this. I mean, when I said before about following up with companies, entrepreneurs, saying, hey, let's touch base in 4 months. I mean, just so you know, I do a pretty good job, but in 4 months, I've probably seen another 120 companies and told another 10, hey, let's follow up. I'll bet I get follows up. I bet I get companies to follow up with me 1 or 2% at a time, 5% at a time.
So if you treat people like transactions, you get transactional networks. You treat him like he's a money provider and only talk to him when you need him for an ATM, it's not going to go well. It just doesn't work. That's why people are bad. So said another way, this is a question of how do some people raise venture so easily? Why is it so irritating? Why is the game rigged? We're just now helping you understand how to de-rig the game for yourself and how people end up de-rigging it. Right? One way is you build a $100 million company, but the more interesting way is you get embedded in an ecosystem and a network of relationships that include CEOs of other companies, include venture investors, include your professors. I mean, don't kid yourself. He's looking around right now at people who are smart. And I know this because another of his colleagues has me give him a spread. Do you see the spreadsheet? Or do you just?
I have, I know. I'm going to have to talk to Chris about it.
So did you know that there's a spreadsheet that I give his colleague that lists all the people that I think are actually smart in all my classes over the course of a year and I do it every quarter. Remember the Velvet Rope conversation we were
Got
having?
really quiet when you said that.
Just out of curiosity, how many other professors do that?
I know you guys do it with 2 others.
I think so.
It is not uncommon.
This started because we had, there's a professor at BYU that does it.
Yeah.
But we've had one, I think in the last year, or even more so than that, one girl that reached out on this list to Chris, came in and said, wow, I'd just really love to work for a startup. She had, again, we talked to some of the other people, met with her, got to know her, she's super sharp. And we introduced her to Joint, which is a tech guy in there, Joint. She went and worked there. They immediately, they moved her out to London as a manager over there, project manager. Then they just moved her back. They absolutely loved her. But I'll bet in a few years she's the only one that ever came and said, boy, I'd really like to follow up and get to know you. So that's where the list started. One, do you have a list? And 2, are any of these people ever going to talk to us? And again, she's one out of.
So I shared that as part of I'm not trying to scare you or be mean or brag that I'm doing something cool, but the world is scouting for bright people. It's just I'm sharing behind the velvet rope. There's a whole world out there that around instrumentation, around management, around executive, how you approach your day-to-day life as an executive, and how you recruit, that no one bothers to talk about. And I sort of forget. I mean, I probably should have told you that. But I mean, I don't know whether that would be interesting or not to you. But we sort of take for granted that, like, oh, obviously you guys would know that, like, I'm tracking all of you, and that people are all calling me saying, do you know any smart people in any of your classes? And I go, well, a lot of them are smart. What specifically are you looking for? Someone who looks like this. And then I make introductions. It happens all the time. Or I shove people over in a big pile to you, and to be honest, I've recommended 4 promising people to your firm, and every single one of them has a dream job next to you guys. Yeah, and unfortunately, 2 of them are out of state. It's awesome, but you guys have been great. Like this collaboration, it's been really nice. Like you guys are an accessible, available, kind, motivated group of venture guys that are clearly embedded in the community. And I'm just trying to say, look, you know, this interaction should be something that you guys should be much more porous. You should only not talk to Epic when you're trying to get a job or when you're trying to get money. You should find ways to interact with them that are valuable, and there are plenty.
Yeah, no, there are plenty. And to be fair, I do try to be overly, I get teased within Epic that, why are you wasting time on that email? I do try to be thoughtful. I do read everything that comes in that I see. A lot of times it's just an immediate no, but I do scan it. If I have thoughts, I'll put them down.
Let me think about this for a minute. No, bye.
Yeah. So I do get teased internally when they're like, just quit, you're wasting your time. But I do try to be thoughtful. But there are ways, you know, so one of them, this is interesting. So a high school student reached out a few months ago, or probably, this is probably almost a year ago now, reached out and just said, hey, I've got this company, this nonprofit that I've started. I'd just like to talk to you. Okay, it's rare that I ever get a high school student. I thought, that's a pretty motivated kid. Sure, I'll talk to you. So I had a call with him. He told me what he was doing, asked a few things. I gave him some suggestions, and you know, and a few he was excited about, a few he wasn't. Anyway, about 3 months later, 4 months later, he came back and said, hey, I just did a TED Talk, posted his little link in my screen and said, I just gave this presentation on my Bags to Riches company. Take a look. If you have any thoughts or anything, let me know. Okay. Another 2 months goes by, and he emails me back and said, hey, I'm really interested in, you know, I've got that going, but I'm interested in a job in a startup. He said, I'm not looking for any money, I just want some experience. And do you have any companies that you know that would be interested in hiring an internship for a month or so? So I sent back and said, hey, you're in Utah, here's 4 companies that we have in Utah. Look through them, if one of them sounds interesting, let me know. So he got back after a day or 2 and said, I'd really be interested in this one. And so now that just happened, so now I'm taking it from there. So there's one that, you know, in non-threatening ways, over the course of 9 months, I keep reading it and keep looking at it. You know, there's another student that he's out in the Midwest somewhere, but that's what he's done. He initially wrote in and said, hey, can I have an internship? And I said, no. We don't really, I mean, if at best we have 1 intern, and there's probably 50 people that want that. So I said, you know, we've already hired our intern, but I said, I don't know locally, but if you're interested, because he said, I'm interested in analysis, I'm interested in startups. I said, why don't you go check with a couple of incubators? They're probably around. There's also consulting groups if you're interested in the analysis piece. There are other avenues you can look at that might be easier. So I didn't hear anything. About another month later, he said, hey, I checked with a few of these. It didn't work out. Here's what I'm doing now. And, you know, just thanks for your help. And so I've got another email from that. And again, in non-threatening ways, they're just always kind of in front of me. And that's
Does
kind
Piercing
of
the veil help at all? Is that part of the dialogue helping, like the velvet rope stuff and the communication and the other? Okay, it's all, this stuff is all available, and this particular part of the conversation can generalize to any particular thing that you care about, whether it's being an investment banker, hanging out with venture guys, or like I want to spend some time learning about how CEOs work. Right? You just go find them, and you are around them and you don't try to take anything from them. Because there's nothing more annoying than going to an entrepreneur meeting and having some dude getting in your face and hitting you in the corner to tell you about his idea. Why don't you just wait? 3 meetings later, that guy, now Ryan and I know each other face to face. I've seen him, she's seen me, I've seen him. I haven't asked him for anything, right? And then I find out that he's going to, I find out that, actually, a better story for me is how I got the connection that helped me get the job that I have in Utah, is I found out that this high-profile entrepreneurship scholar and I were at the same conference. I just hung around him, right, and just listened and found out and just did interact with him. In these environments, it's the same story. Everyone's trying to like be a co-author with these high-profile dudes and talk to them and get their blessing. So I found it both unseemly and unstrategic to try to just be in the pile. So I just waited, and I learned that he was flying home. I learned what day he was flying home. I learned what flight he was flying on. I learned what airline he was flying on. As it turns out, it was none of the things I was flying on. I was flying on a different airline, a different day, a different flight. Pretty quickly, that didn't happen. Pretty quickly, I flew home on his flight to DC, and then went from DC to Salt Lake. And curiously, I spent 14 hours from Australia to Washington, DC with that guy, and we happened to be sitting right next to him. And that single event altered my life, totally changed the trajectory of my research program. It was the first time I got made by a senior academic, and that was that. Right? Find that you find that opportunity for yourself and just do it. It's hopefully that didn't sound unreasonable and insane. Hopefully it just sounded like the logical thing you would do if you wanted to make connections.
Just be a stalker. Yeah.
In a low-key way.
And just add one piece. So networking, you always hear that, especially as an MBA. I heard it from my MBAs, network. I never understood what that really meant until, he didn't mention the other piece of my background. I did help start a private banking division in banking data. And I didn't get it until I did that. Networking takes about a year at best. And it's just meeting, it's getting out there. Because it takes, in my experience, it takes about a year before people start to recognize your face and your name. And go, oh yeah, I know so-and-so, they're doing that. So, again, what I usually tell is, I don't think you're going to see any fruits of networking for at least a year.
Yeah, so start now before you even know that you're going to start a company or need a job. You're already interviewing for the job that you want now. You just don't know it.
The only jobs I've ever gotten, I've gotten at parties. Every single job.
It's because you're a party.
Yeah,
it's very easy when
I'm
it's
such a party.
It's like, Ken, what's going on? There's like girls everywhere, and the disco bar's going. Ken's got like 18 people around him. He's like, I think someone needs your job.
I have a buddy in New York that has parties like that. I do not have parties like that. Or get invited to parties like that.
So, it's not these guys at the closing on that particular conversational arc, right? Networking is non-transactional. It takes a long period of time. It's easy, it's surprisingly easy to do. These guys are incented to want to spend time talking to people. They're going to want to spend time to talk to people who are talking to them about something more interesting than their next business idea and pounding them into a corner. Other questions for these guys?
Be creative, like his flight. Be creative. I used to call up, I work with high net worth, but I used to call up the clients when I knew they weren't in their office at like 5:30 or 6, just to leave them a message that said, hey, I just didn't have a chance. I haven't talked to you in a while. This is Ryan. Hey, if you need anything, give me a call. I'll talk to you soon. Just so they knew, had my voice on their email. They kept thinking about, oh yeah, Ryan does that. So, I mean, there's lots of little things you can be creative about.
Do you guys have a list and do you work it? Get a list, work a list. Seriously, have a list.
I send Christmas cards to the folks that I'm going to ask to invest in my next fund. So I'm sure they're just like, oh my gosh, who's this guy? But then after 3 or 4 years, they're like,
that's funny.
I must know this guy because I get a Christmas card from this guy.
That's really clever. So you don't even know them?
No, I know them.
Oh,
but I mean,
that would have been a better story if you're just like, there's a set of high net worth individuals. Honey, we got another one from the Crolls, and it's this long letter, and things are going, oh, I don't know where we met them.
they have kids.
Kids are great. that would be
Talk to me in a few years, I might try that out.
But in this case, like, I don't know that they know me. Like, I know who they are, have a legitimate reason to like have had touch points with them. And when I follow up with them, I will include an email that's like 4 or 5 years old, right? Like, hey, I talked to you back in such and such a year. I'm raising another fund for a different firm. You know, it's different than my old firm in these important ways. You know, I'm going to be in town. You want to get to lunch. And I'll probably get most of those lunches.
Those issues generalize, right? It's just, do you guys have a networking class or a practical class? You guys are aware, so I'm not trying to be funny, we are aware that like 80 to 90% of the business that you're going to be doing is a matter of your interpersonal relationships, and so the geographic location in which you center your post-MBA job is super crucial to your future work earnings potential. So these all okay. So talk to your career services people about that. I'm sure that they're totally up to date with all the academic. Other thoughts on for these poor guys? You guys you can sense the energy is flagging. So
I'm hoping to scare you with the year-long networking, except for probably still.
Yeah, I hope I didn't freak you out with like you're on my list, but you are on my list, right? So I got you.
You definitely freaked them out with that.
Yeah,
I got to see all. I could literally hear the Facebook pages close when it's apparently like only the best couple are going to get your referral.
Well, it's not that way. I got my eye on all of you, right? It's like because it is true. I've probably told this story before. Like some of you will come back and you will ask me for.
You mean like they won't graduate and not take the class again?
Oh,
different comeback.
Like, there's either conversation is fruitful. One is a learning lesson, right? One is, oh yeah, because it's the case. I remember. It's like, oh, I mean, trust me. I mean, I sound funny, but like I remember. I remember you, right? And I have your emails. I have your top performances. I totally remember. No, I'm not going to give you a referral because you fucking took up oxygen in my classroom. Right? And don't take it personal, and let that be a wonderful learning lesson for you. I just taught you something valuable about the world and how it works. And it's not personal, right? That is what happens when you take up oxygen in the classroom. Or you didn't take up oxygen in the classroom. Great. And I can refer you, right? And that is a learning lesson too. But the world, that's the world functions like that way. You're interviewing in my class, in this class, you were interviewing for a job that you didn't know you want 5 years from now. But somewhere along the line, you're going to go to LinkedIn and be like, oh, that kooky, stupid professor I had that talked a lot, he knows this guy that I needed to know. I'll just email him, and he'll totally help me out, right? We're pals. We took the class together. So it doesn't work that way. So hang out with me afterwards. Let me know what you're doing. I actually get a lot of emails back from from students who are applying that, right? They're just, hey, as it turns out, that crazy shit you told me in class really applied to the job. Thanks, right? That's all they're saying. Like, and they're priming the pump for like 5 years later when they need it.
That's good. I mean, it's what's rare is how little it happens.
Yeah,
I think it's rare of how little it happens. So take the openings when you get them.
And so here's your opening to talk to two guys in venture, and hopefully the takeaways around entrepreneurial finance are. These guys are small. The only reason I would bother to bring in these guys, given the fact that entrepreneurial finance is a corner case, is there's very interesting relational, network, and homophily dynamics that get surfaced in the conversation with venture guys that are abstractable. Otherwise, this entire evening, for those of you who aren't building high-growth firms, would have been another waste of time, right? You should have concluded, why should I even care about talking to venture guys when only 1 in 50 of you will ever need it? It's because the venture environment is a hothouse in which all of the characteristics of business are occurring. Networks, prior relationships, networks through networks, serial entrepreneurs, how due diligence occurs, how relationships get forged. The reason that when you pitch him in the business, it could be the fact that he didn't have a cheeseburger for lunch, right? That homophily is a huge factor. Biases and heuristics in an uncertain environment. All that stuff is present. So with that, I don't need anything more from you guys until next week. There will be no preparation material, and I'm going to leave a name and sign-up sheet. Thanks a lot. I'm going to leave a name sheet here for the n number of companies that would like to sign up to talk next week. Talks are 20 minutes long. The goal is to learn. You guys are more than welcome back if you want. And with that, thank you for the extra time and tolerance, and have a great night.